Amazing. That goes hand in hand with the Fed's announcement back on Monday morning of unlimited, infinite quantitative easing. And why is that? Yeah, they got to save some of these markets that have jammed up, but it is so that they can directly monetize all of this debt. The Fed is going to print the cash, and the Treasury is going to spend it. And that is driving gold prices higher at the exact time that we have this physical lockup, and it's creating a perfect storm where we may finally, I kind of figure the banks will wriggle off the hook somehow, Dunnigan, but there's the chance of a complete collapse of the pricing scheme of precious metals is not zero at this point, and it's very exciting.
Welcome back to Liberty and Finance. And Reluctant Preppers, we have a very popular returning guest. Craig Hemke is the founder of TF Metals Report. He joins us this Tuesday, March 24th, 2020. Craig, thanks for joining us again.
Hey, Dunnigan, nice to see you, my friend. You've been advising people to prepare for a scenario like this for quite some time.
Oh, my goodness.
Thank you for all you do and continue to do.
It's been a very educational month and week. Just a week and a half ago on Friday the 13th, actually at 3 a.m. that morning, we got word from a very trusted source close to us who is of the highest integrity that we were going to have some major, what they thought was a rumor of a national quarantine that day. So I put out a bulletin about it and got some people saying, really? And some people saying, well, you better check your sources. And it was that afternoon, in fact, that we had the national emergency declared, and now state by state across the country we've had actually lockdowns. And we live in Ohio, and we are under a state of you must stay at home or else right now since yesterday. Pennsylvania is, California is, New York. Yep. So anyway.
Me too.
Okay. So that's one thing that's going on, but we wanted to talk to you about some of the convulsions that have been happening both with precious metals and the major financial markets, and what are some of these huge positionings and movings and structural changes that are happening just at light speed along with all of this. Today, one of the things two things grabbed my eye today, very strange. One, I had thought, just like people say, buy on rumor, sell on news, we were expecting this big bailout from the Congress to be announced, from big stimulus package or whatever, and the market was roaring northward, and I thought, I think it's maybe a time for some puts, purchase some puts against the spider, and saw that the market continued to go north. And I thought, oh, well, my puts are going to go a lot less value. Maybe I'll cost average down. But they didn't drop. All morning, all afternoon, all up to the close, the puts did not drop. Obviously, the time value didn't change. It must be the volatility that's being foreseen going forward is what's driving and holding that up. That was one thing. The other thing was the story that came out that the aid package that we're supposed to be getting, people have been talking about getting checks in the mail from the government, but it sounds like they aren't going to be checks. They're going to be digital dollars into a digital wallet. So if we could get to that second. But first of all, could you talk to us about the convulsions that the precious metals have been going through in relation to the major markets and what you're watching about that?
Well, it's been a crazy couple of weeks, no doubt about that. And I want to apologize to everybody. I'm trying not to move around too much. I'm actually standing for this interview, if folks haven't figured that out yet. Having a little back trouble today. We had this major liquidation of basically anything that had a bid, which meant you could sell it at that price. Anything that had a bid got thrown out from the 8th or 9th of March through late last week. Gold futures went down. Silver futures got crushed. The mining shares got destroyed. The general stock market is down. Pretty much everything. Margin calls had to be met, and it was just a rush to get into cash because of this great uncertainty. That created an extraordinary demand for physical precious metal. And last week we started hearing about shortages and dealers getting completely wiped out of their inventory. Premiums beginning to soar. People tell me they could go on eBay and find silver at $25, $28 an ounce when the price was on COMEX was 12, that sort of thing. And that now condition persists, obviously. And now we have the rare occasion that we've never seen before. The Royal Canadian Mint, the U.S. Mint, have now had to close because of and completely shut down their production because of the virus. But also the major refiners of gold in Switzerland are also now offline. So this all comes at a time when the banks that make the markets and operate and deliver metal in London and some in New York, Hong Kong, and the like, the banks they've been running this kind of a confidence scheme now for decades of just-in-time delivery, unallocated metal, heavy leverage of every single ounce. And you and I have talked about this before. That system works as long as people keep their confidence in it. They'll say, okay, yeah, you know what? I'll go with this unallocated account where you promise me I can get my metal in 90 days if I ever ask for it. But in the meantime, I just kind of own a promise of future delivery. It saves me on storage fees, that kind of thing. And the banks love it because they can create as much of that as they want. Well, then when confidence in that scheme fails, and Dunnigan, as we speak here on Tuesday night, March the 24th, we're right on the precipice of the confidence of that scheme failing. We saw that in the market action today, and now late today, and you may not even have seen this yet, as I just saw it for about 15 minutes ago. We're getting word that some of the major banks on the New York COMEX Futures Exchange are filing to be allowed to deliver London gold bars. Because in New York, they deal with 100-ounce bars, but in London, they deal at 400-ounce bars. And so they're petitioning to make these rules changes, which could be the first step in getting out of the London and New York markets entirely, trying to eliminate that risk because they know what's going on. We'll talk, I'm sure, in a second about this stimulus package that's finally getting done. You may not have seen this because this was announced in the last hour. It began at 1.2 trillion, and then it went to 2 trillion. And then I saw some numbers bandied about yesterday of 2.5 trillion. Have you seen the actual size yet, Dunnigan?
No.
Oh, dude, this is awesome. I get to see your face when I tell you this. At Trump's press conference this afternoon, like an hour ago, he brought up Larry Kudlow. You ready?
Yeah.
$6 trillion is the size of the stimulus package that's going to get pushed through. $6 trillion. That's going to make the U.S. run a budget deficit this year. They were already going 1.2 trillion before this. Tax revenues are falling off a cliff. Okay, so if you just go off of that, it was going to be 2 trillion because you're going to lose probably $500 to $800 billion in tax revenue. And now you throw 6 trillion in new spending on it, you're going to have a budget deficit this year of 8 trillion. The total debt is what, 24?
24.
Amazing. That goes hand in hand with the Fed's announcement back on Monday morning of unlimited, infinite quantitative easing. And why is that? Yeah, they got to save some of these markets that have jammed up, but it is so that they can directly monetize all of this debt. Fed is going to print the cash, and the Treasury is going to spend it. And that is driving gold prices higher at the exact time that we have this physical lockup, and it's creating a perfect storm where we may finally, I kind of figure the banks will wriggle off the hook somehow, Dunnigan, but there's the chance of a complete collapse of the pricing scheme of precious metals is not zero at this point, and it's very exciting.
You mentioned, in addition to the $6 trillion from the government and the $2 trillion deficit, $4.5 trillion expected by the Fed to purchase everything in sight. That was before they changed the number from 4.5 to unlimited.
Yeah.
That's true. We have a bunch of questions from viewers, but before we get to that, can you weigh in on that? We've been hearing warnings for a long time from various people in our camp that the next push will be for a world currency, or at least one that is cashless completely, and that we won't have the ability to, because everything you just described is inflationary, and it causes debasement of the currency, and people who have had savings, people who are wage earners, people who have defined benefit pension plans, all of that hits them directly because there's nowhere to get the gains that they need in a zero interest rate or negative interest rate when the dollars are becoming play money. But what happens next is we've been said from the Congress, they're trying to pass a bill that the so-called bailout checks to the American people would not come in the form of checks, but in digital dollars into a digital wallets. What do you know about that, and what does it mean to the ordinary person?
Well, I just heard about that today too. Whether, and I've also seen they're just going to direct deposit this money straight into your account like they do if you filed that way to have your income tax refund come that way. I'm not sure. It'll be interesting to see how they ultimately deliver it. I've seen this thing about some new digital Fed coin. I don't know. I would suspect that's a possible piece of the puzzle going forward. I mean, at this point, all we can do is hope for the best, pray that somehow, over the next month, maybe we buy some time, we isolate enough people, we halt the spread of the coronavirus, and we find a therapeutic or two, like this hydroxychloroquine or remdesivir or something, an existing therapeutic that works. That every day that goes by, we're learning more and more about the possible uses of some of these existing drugs to keep people alive. And if we can just somehow, Dunnigan, get it to where, instead of 2% of people dying, which is 20 times greater than the flu, if we can get it down to 0.2 through one of these therapeutics, well, then we can, I don't want to sound crass, but we can live with that. If the flu's 0.1, if it's only twice as deadly as the flu, people will go back to work and restaurants will open back up and all that kind of stuff. That's really the best case scenario at this point. Excuse me, at this point. And so your best case scenario is an $8 trillion budget deficit this year. And all this cash created from nothing to keep all of the bond markets flowing and to keep the real estate from falling apart and the stock market from falling apart and keep businesses open and everything else. That's your best case scenario. This is all that will have to be done. Okay. What you're kind of describing is, what if it doesn't work out that way? What if you get into a situation, some have called the big reset, where a total change in the global monetary system, because basically everything collapses in this deflationary, just implosion. If that's the case, there's all kinds of speculation that's been done on that over the last 10 years, ever since the great financial crisis. And I don't know what to expect. I really don't. Anything is possible. I would imagine the next phase won't be the U.S. as the sole global reserve currency. There may be some combination of the IMF's SDR and some other countries' currencies. There may be something completely new, like you said, not necessarily a Fed coin, but an IMF coin or whatever you want to call it, where the whole world goes on to one single currency. I have no idea. I have no idea. But this is all stuff we've all thought about and, kind of thought experimented with over the last decade. And I mean, honestly, I really hope we don't find out. I pray every night that somehow we get a reprieve from this. The veil of dread gets lifted a little bit, and we kind of can see ourselves coming out the other side in 6-8 weeks. But boy, if we don't, all bets are off. Anything could happen. The only thing I would add to that, Dunnigan, is that history is replete with examples of fiat currencies. What I mean by that is just paper money. Money that's just conjured up from thin air, like what we're doing now. It has no anchor to it. They can just print as much as they want. That's typically the end game in a monetary system. And as the pendulum then swings back to the other side, you almost invariably reset back to some form of sound money that has some type of hard asset backing to it, gold, silver, something. That it will probably be gold. I've always thought will probably have a key role in whatever the next monetary system is. Whether we have that in 6 months, I guess now is the question.
Yeah, the other thing is, as long as the same people are in charge, just like we saw after the 2008 global financial collapse, there was no real systemic cure of the disease. It was just more of the same. And it seems like the cures that are being proposed now are even more of the same. We just keep going up in order of magnitude each time. So it's hard for people to hold out hope that the same players at the helm are going to result in a different solution if they've gotten used to being able to do, as you just said, print as much cash as they want to try to solve problems. We have a question. This ties back into what you were saying earlier about the COMEX and the London Exchange and so on. Actually, you said New York and London. Josh G. asked, does Craig feel the GLD is safe to invest in? What are the implications if its custodian is HSBC and or the trustee, State Street Corporation, go bankrupt or need a bailout?
Yeah. No, I never owned a share of that thing. I think it's a sham. I wouldn't touch it. People use it as a trading vehicle, which, I mean, if you want a 2 or 3 day exposure to gold and you're willing to take all that counterparty risk that person described, then knock yourself out. But it's certainly not a long-term thing. It's not something that you personally can get physical gold out of it. The only entities that can get physical gold out of it are the big bullion banks, JP Morgan and Goldman Sachs and Deutsche Bank and the rest. The individual, cannot get any. You just are simply exposed to the price. And then you may not even be that, because if it's found to hold not all the gold that's there, or if it's all, some of the GLD gold is in some other ETF and also in this ETF, and it's all just spread around and nobody knows who owns it, well, then your shares aren't even going to have tracked the price. I mean, that invariably is going to flow through to the net asset value of the share if it's not fully backed. So I wouldn't trust that. I'd like I said, I've never owned a share of that thing. There are much better alternatives if you're looking for exposure to price than that thing.
We've got a question from Mark Lynette, who asks, why should we not believe that gold and silver will rise and buck the commodity trend? He goes on to say, the commodity trend of downward prices in an economic downturn. And I think you were getting into that before about this perfect storm of constrained physical supply at the same time that we're having low prices and record demand. Yeah. Well, gold, first and foremost, is not a commodity. If you watch CNBC, they'll try to tell you that. But gold is money. Okay, gold is every bit as much a currency, foreign currency, if you will. It's always compared to all the other paper currencies, gold priced in yen, gold priced in pounds, gold priced in dollars, all that kind of stuff. Gold's money, has been for millennia. So I wouldn't group it in with the rest of the commodities. Now, silver used to be money as well, but it hasn't been now for, a century. And so it's often thought of as a commodity, and it has, that's part of the reason why it's gone down over the last month. Is you look at copper, you look at, crude oil, which is a commodity, has gone from $60 a barrel to $20. So all of that selling on an expected global slowdown of demand for the actual commodity itself has impacted silver. What will happen, though, the individuals, whether they're high net worth people or hedge funds or just you and I, we recognize silver as money. And at some point you get almost like a substitution effect, like where, the guy that went broke stopped buying steak, so he brought hamburger, right? At some point, people are going to go, whoa, look at what gold is, but I can't afford an ounce of gold. That's out of my price range. But you're telling me that, I can buy 100 ounces of silver instead? Sold. And you get that substitution effect that allows silver to catch up. The key, though, in all of this, though, done again, and so few people have a grasp of this, is that the price since 1975, so what is that, 45 years, has been determined through the creation and supply and demand of these futures contracts, which are purported to represent a possible future delivery of gold or silver. But there's no physical gold, there's no delivery that ever gets made. And there's no physical metal to back up, the mass quantity of these derivative contracts. So really it's like trading baseball cards and using, the supply and the demand of the baseball cards to price something completely different, gold or silver. And it is this system that has been foisted upon us since 1975 that we now know was set up deliberately to cause volatility and to increase the available supply, if you will, to keep people from wanting to own it, from wanting to hoard it and driving prices higher. And they've accomplished that to a great extent. People don't even think about it anymore. Like
author of the question thinks it's just a commodity. So anyway, that system, that pricing scheme, as I call it, is a fractional reserve scheme, just like the fractional reserve scheme that your local bank runs. All the cash that they have on hand isn't held in the vault. They hold 10% of it. Now they can hold 0% of it if they want. Anyway, that's how the banks operate the metal pricing scheme as well. And it is that scheme that, as we sit here on Tuesday, March 24th, 2020, is legitimately in peril. If it fails due to all this phony baloney plastic banana gold and silver that they've created and gotten people to accept as a substitute for the real thing, if it fails and people demand the real thing, then we're going to go to a system where price is just simply determined by, I've got some cash, you've got some metal. At what price do we agree to sell it? It's kind of like right now. Someone can, if they have a tube of Silver Eagles, the price quoted on CNBC might be $14. Go on eBay just for fun and list your tube of Silver Eagles at 25 and see if you get somebody to buy it from you. You probably will. So is the price 14 or is the price 25? That's the direction it's headed.
Yeah, I have to interject here that as a brand spanking new licensed dealer representative for Miles Franklin, that I can confirm that there has been a absolute separation between the paper spot price versus the physical price. However, I will say that Miles Franklin can get you a better deal than anybody else. So please do email me at libertyandfinance@protonmail.com and we'll prove that to you.
Not to tell you how to run your show, but if you haven't had Andy Schechtman on yet.
He's on in an hour.
Good. Ask him to explain it, because people think, well, the reason, the dealer is offering it at 22 is they're either trying to scalp everybody, and they bought silver at 12 last week and now they're selling at 22 to scalp and gouge everybody. That's not true.
Right.
Or they say, well, they actually bought it at 18, a couple of months ago, and they don't want to sell it at 14 and guarantee a loss. That's not true either.
Right.
Andy, I'm sure, can explain that to everybody. I won't steal his thunder.
Yep, we'll definitely get into that. Let's talk a little bit about, you mentioned how gold, for example, is compared to other forms of, it's money and their currencies, but it's compared to all the currencies around the world. What about the ratio between precious metals, between gold and silver themselves, or between gold and platinum specifically? Let's take those one at a time. Can you hit us up with gold and silver first?
Well, let me jump out of order though. I don't pay a lot of attention to platinum. So I'll just say right now, the gold to platinum ratio isn't something I want to try to make it sound like I know what I'm talking about. The gold silver ratio, I'll be happy to. Because again, when we were exchanging cash for physical metal, as we had until 1975,
right,
okay, for thousands and thousands of years, it was basically the price was a ratio of how abundant they are. If gold comes out of the ground, 1 ounce of gold for every, say, 10 ounces of silver, and they're abundant in a 10 to 1 ratio like that, then you would think that if they're both used the same for money, that the price of silver should be 1/10 the price of gold. Okay, and again, it fluctuated on that 1 to 15, that type of thing. We call that the gold silver ratio. It's been like that forever. Well, now all of a sudden it's 115. Why that? Why? And people come up with all these reasons. Well, silver. We're all trying to explain away the simple, bald fact that's staring them in the face. Price is determined by the trading of these derivatives. Mm-hmm. And so it's a function of the supply and the demand of the derivative. And you've got all this supply of silver derivatives. That is what, and not much demand for it. And that's what's keeping the price down. And that's why that ratio is widened. I suspect, we won't immediately go from 115 to 1 to 15 to 1. But if all of a sudden next week there was no paper derivative marketplace anymore, if we went back to something 1974 and before, that ratio would tighten up pretty darn fast.
Yeah, that was the question that was coming from Charlie Mack, who said, how long can they sustain 100 plus gold to silver ratio?
Yeah, well, it's like anything else. You can plot it on a chart, the gold silver ratio. It's gone parabolic. And everybody knows, anything, doesn't matter what it is. Things don't just continue to go parabolic straight up. Even the coronavirus is probably a bad example, but, it's going parabolic and growing exponential, but it won't forever. It'll roll over, slow down, and then the amount will come back down. That gold-silver ratio is going to do the same thing. When? We'll see. I thought it would get to 100, and people thought I was crazy. Mm-hmm. We've gone past that. And again, because it's a function of the scam, the fraud of the pricing scheme. That is. Having it at 115 when the historic norm is 15 gives you some idea of the scope and magnitude of the fraud of the scheme of how it's priced.
A follow-up question to something you brought up earlier about shutdowns of the major mints, both in the U.S. and Switzerland. Yeah. Chris William asks, when will the paper and physical markets and metals separate? We've talked about that. And the Swiss refiners have now stopped all operations. What impact will that have? Can you kind of walk us through what you think is the most realistic forecast of likely next steps or stages with these major mints not being able to produce anything?
This is unprecedented. And you can Google, Bloomberg had an article today about this. You can find stuff on Google about how unprecedented this is. Metals dealers quotes going, I can't believe I never, all through World War II, the mint still ran, or the refiners still ran in Switzerland. Now all of a sudden they're not. And when I use the term bullion bank, what I'm talking about are these major banks that have, their fingers in everything as investment banks and the rest and too big to fail and everything else. And one of the businesses that they run is bullion delivery. They run the physical market, mainly through London, okay? And they run it through a whole bunch of smoke and mirrors and fraudulent schemes and trying to bury contracts off the books and all this kind of stuff. But when it comes down to actual physical delivery, it's run in almost like a just-in-time system, like your grocery store. And we're suddenly all kind of getting a lesson in that again, okay? And what is now happening is because you've got all these promises made through these derivative contracts that the banks have issued and, carry on their books, and now there's no supply. And there's no supply for the foreseeable future. And that's when positions have to get unwound. And that's when things get crazy. And that's when these firms get called to the carpet and you get a situation called a force majeure, which basically you throw up your hands and say, I'm sorry, we can't honor our contracts. That suddenly is very much an option. Again, as I've been doing this long enough that I hope it's not cynicism, that I'm just being a little more pragmatic maybe than I was 10 years ago because I've seen the banks rig the scheme and wriggle out off the hook too many times in the past. But what we're dealing with now is totally something completely unprecedented. You had the physical metal supply disappear at a time when demand, not only for physical metal, but for gold in all these different various forms, has just blown through the roof because the coronavirus and the slowdown and now this massive quantitative easing program that's not only the Fed, it's all the central banks around the world. And so it is almost like that perfect storm that may very well bring permanent structural changes to the way gold and silver are traded and priced.
Craig, I know our time is limited and you've been generous to take time out tonight to get with us. I'm sorry about you having to suffer with this back problem
it's interesting.
Along the way. But for people who want to follow your work, tell them how they can get plugged in.
Well, TF Metals Report is a site I've run now for almost 10 years. It's the tagline to it, Dunnigan, you know this, is the end of the great Keynesian experiment is upon us. Prepare accordingly. Well, what we just described over the last half hour is pretty much the end of the great Keynesian experiment. And what I mean by that is Keynes thought you could just keep issuing more and more debt, and keep growing your way along to service it, and it goes on forever. But eventually it doesn't go on forever. You get one little hiccup, and all of a sudden the debt service can't be made, and the whole thing implodes on itself. So that's what the site's dedicated to. But we mainly focus on the trying to prepare by having physical gold and silver as your vehicle to kind of see you through the storm. I analyze things. I write posts in the morning and I record a podcast every afternoon, trying to be my eyes and ears for all the subscribers. It's a whopping $12 a month. So it's only 40 cents a day. But my goodness, whether it's my side or somebody's, and then now is the time that people need to really be paying attention to this stuff. So please check us out. It's just tfmetalsreport.com.
Thanks. We've been talking with Craig Hemke, founder of TF Metals Report, here on Liberty and Finance and Reluctant Preppers. Craig, as always, thanks for joining us.
All the best, my friend. I can't wait to see where we are the next time we talk.
If If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.